Know that feeling, right? You've got the perfect A-plus setup. I mean, you followed all your rules, you enter the trade, and price does exactly what you thought it would. But not before it dips down, tags your stop loss to the absolute tick, and then rockets to your target. It is just the most frustrating feeling, and it's so easy to start thinking the market is, well, that it's actively out to get you.
And look, when that happens over and over again, it's just so easy to start blaming, someone. The market makers, the institutions, these puppet masters pulling the strings. The idea that someone, somewhere, is literally hunting your specific stop loss. And I get it. I really do. For a long time, I was convinced the market was rigged. But what if I told you the reality isn't nearly that sinister? What if it's actually something far more logical? A process that's, well, it's essential for the market to even function at all.
See, most of us, when we look at a chart, we see price moving, right? It goes up, it goes down. So we draw our trend lines, we spot our head and shoulders patterns, and we react to that movement. It's all about correlation. We see a pattern, and we just assume it's going to repeat. But that whole perspective, it completely misses the fundamental why. Why is the price even there in the first place? It's kind of like trying to read a book by just looking at the shapes of the letters without having any clues what sounds they make or what words they form.
So what's really going on behind the scenes? Well, here's the big shift in thinking. The market doesn't just move, it auctions. Yeah, you heard me right. Behind every single one of those candles, every wick, every sudden spike you see, there's a continuous, totally logical auction process playing out. And here's the kicker. It's a process most traders never, ever see. And let me tell you, understanding this, it's the difference between just reacting to what the market does and actually reading its intent.
Okay, so let's really break that down. What in the world does it mean for the market to auction? Well, it means that every single tick, every price point on your chart, it's not just random noise. It's pure information. It's a story, a negotiation unfolding right there in real time. And in the next few minutes, we're going to learn how to actually read that story.
At its absolute core, the market auction is all about one thing: discovery. See, price is constantly moving up and down for one main reason, and one reason only: to find people who are willing to trade. It's always searching for those price levels where it can get the most business done, the highest volume of transactions. Think about it this way. Every single candle you see on your chart is basically an agreement. It's a temporary consensus on what the fair value is right at that moment between buyers and sellers.
So just imagine the market has one simple goal: find people who want to do business. That's it. It's constantly asking this one single question. Hey, can I get more orders filled up here? No? Okay. How about down here? It moves price to a new level, kind of metaphorically rings a bell, and just waits to see who shows up to the party. And believe me, the answer it gets dictates everything that happens next.
And this right here is how we see the market's answer in real time. On one side, you have price acceptance. This is where you see tons of participation. The price action gets slow, it gets choppy, kind of grindy. Why? Because a lot of business is getting done. This is where value is being established. But then you have the flip side, price rejection. This is where participation is super low. And what does the price do? It moves fast, it's directional. The market is basically shouting, nope, nobody wants to do business here, and it's rushing off to find a different area where it can find value.
Okay, so if the market is this giant, ongoing auction, what's the engine? What's actually fueling it? What are the mechanics that drive this whole process of discovery? Well, it really boils down to just a few key ideas, and we're going to start with probably the most misunderstood term in all of trading: liquidity.
We're all taught that liquidity is just this big pool of stop losses waiting for the big banks to come and hunt them down. But that is such a tiny, tiny part of the picture. The real definition of liquidity is just participation. That's it. It's the sum of all the willing buyers and sellers at every single price. And the big institutions, the ones with these massive orders, they absolutely need that liquidity to get their business done without sending the price flying against them.
So let's walk through a classic example of how this actually plays out. Let's say a huge institution wants to buy $100 million worth of something, but there's only $20 million in sell orders on the books. They have a problem, right? They need more sellers. So where do they find them? They push the price down right below a super obvious support level. Now, this move is brilliant because it does two things at once. First, it triggers all the stop losses from the retail folks who bought at support. Boom, they just became forced sellers. And second, it attracts a whole new wave of breakout sellers who think the price is crashing. And just like that, they have engineered the perfect amount of liquidity they needed to fill their huge buy order.
And that is precisely why old highs and lows are so important.
They are not just random lines you draw on a chart. Think of them as historical markers, like little flags planted in the ground that show where a past auction either failed, got rejected, or simply left some unfinished business. So when price comes back to those levels, it's not random. It's coming back on purpose to see if things have changed, to retest participation, and maybe, just maybe, to finally complete the business that was left behind.
Now, what about those super fast, one-sided moves you see on the chart, where price just rips in one direction? Well, that's what we call an imbalance. All it means is that one side of the market, either buyers or sellers, was so aggressive that it pushed the price too quickly for a normal two-sided auction to even happen. The market absolutely hates this. It sees it as inefficient. And so its natural tendency is to eventually circle back to that area to, fill in the blanks, and let all the business that was missed the first time finally take place. And honestly, this is the real reason why most retracements happen.
So when you start putting all these pieces together, it really does lead to this massive shift in your mindset. I mean, once you really get this auction framework, your whole approach to trading just has to change. You stop trying to be a fortune teller, a predictor, and instead you become an observer. You stop guessing and you start participating with the natural flow of the auction.
And this really gets to the heart of the difference. The typical retail mindset sees a pattern, a correlation, and just reacts to it. But the professional mindset, it sees that exact same pattern and asks a totally different question. Okay, why is the price here right now? What is the auction trying to get done? The retail trader looks at a move and sees a trap. The professional looks at the exact same move and sees pure, valuable information about where people are willing to trade, and more importantly, where they aren't.
You know that classic fake breakout that always seems to stop you out? I promise you, it was not a personal attack. It was just the auction in action. It was the market pushing price above a key high to ask a simple question. Hey, are there any more buyers up here? Is anyone willing to do business at these higher prices? And when the answer came back as a resounding nope, what did the price do? It shot right back down to where the real participation was. It wasn't a trap. It was a failed experiment. And that failure, that's pure, unfiltered information for you.
So what happens when you actually start to see this? When you can spot this hidden layer of intent on your charts? Honestly, the practical impact is, well, it's profound. It's truly like putting on a new pair of glasses that just filters out all the chaotic noise and finally lets you see the market's true underlying structure.
All of a sudden, the charts just seem to slow down. They feel clearer. Those super fast, scary moves that used to give you major FOMO, you now see them for what they really are. Simple price rejection, an inefficient search for value. You stop chasing everything that moves and you start waiting, patiently, for the auction to show you where value is actually being accepted. And that emotional roller coaster of fear and greed, it gets replaced by this calm, objective analysis of what's actually happening.
And this, right here, is the core truth that you just have to let sink in. The market is completely 100% impersonal. It doesn't know you exist, it doesn't care about your trade, it is not trying to help you, and it's not trying to hurt you. Its one and only objective is to facilitate trade. That's it. And once you truly, deeply accept that, trading stops feeling like this personal battle and it becomes more like a puzzle you can actually solve just by observing.
So I'll leave you with this final thought. This auction process is happening right now, on every chart, on every single time frame, whether you're aware of it or not. The real edge in this game doesn't come from some secret indicator or a magic pattern. It comes from understanding the fundamental process that drives every single tick of price movement. This understanding, this is the foundation. So the only question left is, now that you know it's there, will you choose to see it?